Welcome to Anu's classroom. We are talking about MMPC 3, that is business environment. And so far in this course, we have been discussing about the various theories of economic growth. So I hope that you might have by now realized the importance of the role of capital formation in both the economic growth as well as the economic development of a nation. So capital formation, what does that mean? Capital formation means an addition or an increment in the existing stock of real capital that is available in the country. So capital, in when we talk about capital in economics, it does not actually mean just money, okay, not just your paper currency. It is wider than that. It is a wider term which encompasses both the physical as well as the human capital. Physical capital as in machines, tools, infrastructure, raw material, definitely money also, and it will lead to more production, profits, and the creation of assets in the future. Whereas human capital, on the other hand, will include all the skills, the training, education, and things like that, which improves the productivity of individuals and especially in the business context of the labor. So, savings and investment is something which is the what you can say core component of capital formation. Saving means the part of the income we are not consuming. The remaining we will spend on various items. Whatever remains after all our spend is savings. And with the current situation of how especially entry level positions and all give out salary, we will at the end of the month we will have nothing to save, right? So when savings is used in such a manner that it gives us returns in the future, it becomes an investment. Like for example, you take a portion of your salary and pay premiums for say some insurance policies, or invest in some mutual funds or in the stock market or something like that. If you do that, savings will convert into investment. So a higher level of savings is what will lead to more investment as well as capital formation, which will in turn become the source of our economic growth. So it is the creation of savings as well as the mobilization of the savings which converts the savings into capital assets, and that will lead to capital formation. So, as that is the case, there are a large number of factors which affect the rate of capital formation in the country, like the income level of the people, the institutional factors like what is the availability, number, and coverage of financial institutions, what is the monetary as well as fiscal policy of that country, what is the prevailing rate of interest, how much is the population, what is the size of the market, and all those things. So, in this session, let us try to understand the importance of the financial system, the structure and working of the money market as well as capital market, and the structure of our banking system as well as the working of capital market along with the various instruments and intermediaries of capital market. So anything and everything that has to be known, basic knowledge on the Indian financial system is what we will be talking about in this particular unit or in this particular session also. We will be covering the entire unit 5 with this one session. Okay. So a financial system, what does it constitute? A financial system constitutes a set of institutions, instruments, and markets which will bring the savers, that is the householders mostly, and the investors, that is the businessmen, to a common platform and provide a means by which savings can be translated into investment. So, the principal objective of a financial system or a financial market is to channelize the savings into the most productive opportunity or avenue. So, in the financial markets, there are two players, lenders and borrowers. So, the individuals or the households who generate the savings and are the people who generate the savings, and they are the people who can have surplus funds also. They can either put this amount of money in gunny bags and hide it or keep it under a lock, how our mothers do, put it inside the what you can say rice, what you can say, that uh, or the floor jar, right? Or put it in the in the almirah, okay, in their master bedroom and lock it. That is how it was done earlier. So what happens with this form of savings is that it will not yield any return, and also there is a constant fear of theft, right? So on the other hand, what we do, capitalists or entrepreneurs, they cannot undertake any new projects of production or expand their existing production capacity because they are not having enough capital. How will they have? Everything is under rise, Correct. So the major role of our financial system or the financial market was to bring the householders, the savers, and the people who need money, that is the capitalists or entrepreneurs, together. So those who have savings, okay, it could be savers or even lenders who are willing to lend their money. They also will put their funds into the banks or any other financial institutions. And those who are in need of money or finance, they are called the borrowers. They will take the money from these financial institutions, and this interaction, both lenders and borrowers will gain. Ultimately, due to increased efficiency, production, and exchange, the whole economy will also get benefited. So, financial markets will be in this regard, you can understand they perform many functions. At least a few of the functions of financial markets you need to know. Some of the functions are, definitely by now you might have understood, they connect the borrowers and lenders and lead to the process of price discovery or determination. They provide liquidity in the system by helping to allocate funds in a very efficient manner. And they, what you can say, bring forth an ease in the access of funds to the borrowers, which will in turn reduce the cost of transaction. And they also, the financial markets also provide as a way of managing the uncertainty as well as controlling the risks of this lending and borrowing. Okay, so financial markets, they have two main components, that is the money market and the capital market, and they are both essential for the economic development of a country. The money market is the market for short term financial assets and assets that are close substitutes of money. Assets close substitute of money is like the commercial papers or the treasury bills and things like that. In place of money, what you can use. Okay, so short term implies that the time period of these transactions will be at most 1 year. It will be less than or maximum 1 year. And these close substitutes of money are those financial assets which can be converted to money with minimum or absolutely zero transaction cost without the loss of any value. The major participants in the money market are the scheduled banks, scheduled commercial banks, excluding the regional rural banks or RRBs, and even cooperative banks. In cooperative banks also, we do not include land development banks and primary dealers. Okay, excluding them, everybody, all the banks are participants of the money market. So the objectives or the functions of money market, we can broadly put it as: number one, to provide an equilibrating mechanism between the short term surplus and the short term deficiencies. Like I have, say for example, I have 1 lakh rupees today, which I don't need till tomorrow. Okay, my friend needs 1 lakh rupees today, and tomorrow he'll get that 1 lakh rupees, so he will not need it anymore, but today he doesn't have. So what will happen? In a money market, I have a surplus of fund in the short term, I need it tomorrow, he needs the money, he's in deficit today for a short term, again he'll also get his money tomorrow, so today only he will need, so I can lend him, he can lend it back to me, I will have money for tomorrow, he will have money today. So that is the concept of money market. Okay, so it provides or it maintains a liquidity in the system and provides access to short-term funds to borrowers at minimum or realistic cost. To enable the central bank of the country intervention to influence and regulate the liquidity of the economy, also money market helps. The main instruments that are traded in the money market and the sub-market are call market or the notice market. So this is a market for short-term financial funds that are payable immediately and in full when the lender demands them. So the maturity period of such funds, they vary from 1 day to maximum of 14 days. When the funds are borrowed or lent for a day, we call it call market, that is overnight money. If the duration of the borrowed or lent money is more than a day, maximum up to 14 days, we call it notice market. For conducting transactions in the call or notice market, we do not need any collateral security. And the major players in this market are banks and primary dealers. And the interest rate payable on these type of loans are known as the call rate. These type of loans are called call loans or notice loans, and call loans, and the rate of interest applicable on these type of call loans are called the call rate. Similarly, another type of instrument that is usually found in money markets are called as the commercial papers. Okay, so these are also short-term unsecured instruments that are issued by companies to raise short-term debts. They can be issued in the denomination of 5 lakhs or multiples of 5 lakhs. Then we have the treasury bills or the T-bills, which are again short-term borrowing instruments given by the government of India. Generally, treasury bills and all, if it is a bill of say 200 rupees, you need not pay the whole 200 rupees. You might get it for like 198 rupees or something like that. So that difference 2 rupees is what you can say is something which the borrower need not pay. But when you encash that treasury bill, you will get the full 200 rupees back. It functions, some bills are like that. Then we have the commercial bills market, which includes the bills of exchange and promissory notes. We have certificate of deposits market, which are negotiable money market instruments against funds that are deposited in banks or any other financial institutions for a fixed time period at a specific rate interest. We also have money market mutual funds. Okay, so the Indian money market is generally divided into two parts: the organized sector and the unorganized sector. The organized sector consists of the Central Bank of India, nothing but RBI, and commercial banks, both nationalized as well as private banks. And even foreign banks and cooperative banks and Discount and Finance House of India, other financial institutions like IFCI, ICICI, LIC, all those what you can say institutions also operate in the money market. Whereas the unorganized sector, they consist of non-banking financial intermediaries like indigenous bankers, money lenders, non-banking finance companies. Okay, such people operate in the unorganized money market. So this is a what you can say a relatively an important topic itself for our term and examination. So I hope you guys will take a good look into this whole unit. I would say this is an important session you need to know, because either most of the years we could see that either a money market question is there or a capital market question will be there. Okay, so this is a relatively an important unit, I would say. So banks, the banking structure of India, we need to know. Okay, banks are the most important segments of money market, as you might have already observed. And according to the Banking Regulation Act of 1949, it defines a banking company as a company which transacts in the business of banking. Okay, and banking means accepting deposits of money from the public for the purpose of lending or investment. However, with the promise of repayment on demand by the depositor, with a facility of withdrawal by either a check, draft, or order, or something else. Recently, even ATMs and debit cards and all, right? So the functions of banks, they have changed a lot from the traditional functions, that is just accepting the deposit and lending of credit, to more functions like collection and payment of checks, bills, promissory notes, sale and purchase of securities, remittance of funds, merchant banking, service of allotted teller machines, that is ATMs, electronic fund transfer systems like NEFT and RTGS, dealing with foreign exchange, and a lot more things. Okay, so how is the banking structure of India? What you see on screen right now is the structure of the banking system in India. At the helm of the affairs, we can see there is Reserve Bank of India, or RBI, which is the regulator of the banking sector, and it is RBI which supervises the monetary policy of the country. Under RBI, we can see that both scheduled banks as well as unscheduled banks operate. So scheduled banks could be commercial banks or scheduled cooperative banks. And commercial banks could be the public sector banks like SBI and its associates, or any other nationalized banks or other public sector banks, or it could be private sector banks or foreign sector banks or regional rural banks. Okay, so SBI we all know, right? Private sector banks like HDFC, Axis Bank and all. Foreign sector banks, you might have seen Bank of Bahrain and Kuwait and things like that here. Regional rural banks, cooperative banks like we have over here nearby itself. Like in Kerala, it is a very, I mean, like every other town will have a cooperative bank. Okay, even in like nearby my house itself, like multiple cooperative banks operate. So that is a cooperative banks. So these are the what you can say the general structure, banking structure of India. So this is again an important topic. On the whole, I would say unit 5, please do not miss it. Okay, so RBI is a apex bank of the country. Questions have been asked exclusively about RBI and its functions also. So this is again an important topic. So RBI is the apex bank of our country, and it acts as a regulator or of the financial as well as monetary system. It was established as a banker to the central government by the Reserve Bank of India Act in 1934, and it began its operations from April of 1935. When it began its operations, it was a private shareholders bank with a built up capital of around 5 crores, and it was in 1949, after independence, we nationalized RBI. So RBI got created even RBI got created while the Britishers were still here. And some of the major functions of RBI are: RBI acts as a note issuing authority. If you check any of our notes, you will find coins, you will find it was all issued by the Reserve Bank of India. It is a banker to the banks. It is also the banker to the government as well as the government's debt manager. It is a banking sector regulator, foreign exchanges manager. It has the what you can say function of maintaining the financial stability of our nation. It also has a developmental role to play and is also the regulator of the monetary policy of India. So, as I said, this is an important topic from your term and examination perspective. Definitely go through the course material of MMPC 5, sorry, MMPC 3, Unit 5, okay, and try to memorize all these key functions of RBI. If possible, let's see, I will try to make a separate video wherein we will go in depth about Reserve Bank of India and its various functions. But in any case, if it is possible, if I get the time, definitely I will do it. But if not, also I request you all not to skip this section, okay, 5.5, detailing RBI. Actually, do not skip Unit 5 only, I would say, okay, while you're preparing for your term and examination. I hope I was able to drive in the importance of this unit. Multiple questions have been asked almost every, since see this block has I guess around three units only, this block 2. Okay, this is part of block 2. So definitely you will get at least 2 questions per block, and most cases this unit has 1 question. That is how it is. So, coming to the scheduled banks of India, let us talk about the scheduled banks of India. Scheduled banks are those banks which are included in the second schedule of our RBI Act of 1934 itself. And these banks need to have a paid up capital and reserve of not less than rupees 5 lakhs. So, you might have by now understood these amounts are old amounts. Okay, and these also need to maintain a CRR balance with the RBI, and they can raise debts and loans from RBI at the bank rate. Scheduled commercial banks are further classified as public sector banks, State Bank of India, that is SBI and its associates, old and new private sector banks, and also foreign banks. So public sector banks or PSBs, they are those banks which are more than 50% of shares held by Government of India. And these are the major types of banks in India, these public sector banks. And as of 2021, we have 12 PSBs. Like we have SBI, which is the biggest of all, Bank of Baroda, Bank of India, Punjab National Bank, Indian Overseas Bank, Punjab and Sindh Bank, Indian Bank, all these things. Bank of Maharashtra, Central Bank of India, Canara Bank, Union Bank of India, all these are scheduled banks. Of this, SBI is the biggest commercial bank in the country with nearly 25% of of the market share. It has over 22,000 branches and more than 50,000, almost 60,000 ATMs. Private banks are those banks which are in which the majority of the stake. So public sector banks, majority stake was with the government, whereas when it comes to private sector banks, majority of the stake is owned by the private shareholders. In India, private sector banks are also classified as old banks, old private sector banks, and new private sector banks. The private banks which were not nationalized in 1969 are the old private sector banks, and they also include banks like the Jammu and Kashmir Bank, Lord Krishna Bank, and all. As of April 2021, there are 22 private sector banks in India. Few of the famous names in this sector are ICICI, HDFC, and all, Axis. Right? Foreign banks, they are those banks which have headquarters in a different country, but they have branches in India. There are 46 foreign banks as of 2020 in India, and these banks also have to follow the rules of both their home country, okay, as well as our, that is the host country, like Bank of America, Bank of Ceylon, National Australia Bank, BNP Paribas. All these are foreign banks in India. Next, then, what you can say, another important topic that we need to learn as part of Unit 5 is about the capital market. So far in this section, we have all been talking about the money market, which provided with short-term funds to investors for less than 1 year. But as we all know, business units and investors will need funds for longer durations also, if they are to undertake any kind of business expansion or technology upgrading and all that things. So when this need arises, they will approach the capital market. When they need short term funds, they will approach money market. When they require funds for longer terms, they will approach the capital market. So capital market is like a market for long term securities or financial instruments having a maturity period of more than 1 year. And these capital markets are very important for channelizing of savings, capital formation, as well as industrial growth. So on the screen right now, you are seeing the structure of the capital market in India. The capital market comprises mainly of two markets, the primary market and the secondary market. Primary market is also known as the new issue market, where the issuer of the securities, that is shares or bonds and all, will sell new securities to the investors without any intermediaries. Whereas, so whenever securities are offered for sale for the first time by the companies, they are called initial public offerings or IPO. IPO is issued to raise capital for all the funding purposes, and both the companies and the government can use this primary market to raise funds by the sale of new stocks. And then we have the secondary market, that is also known as the stock market. BSC, NSE, you might have uh, heard their names, right? Naam to suna hoga, Bombay Stock Exchange and National Stock Exchange. So this is a place where shares or bonds, options and all, which were sold earlier, okay, in the primary market, they were already sold once, they are again sold and purchased. In India, you must have heard of BSE and NSE. They are some examples of stock exchanges. In America, we have Wall Street, right? The secondary market can either be an auction market or an over-the-counter market. In the auction market, the trading of securities is done through the stock exchange, whereas in the over-the-counter trading, it is conducted without any use of platform of stock exchange. It does not have any physical location, this over-the-counter stock. Okay, and trading is also done electronically. Some of the major financial instruments that are used in the capital market are the shares, bonds, and debentures. So there is a large number of intermediaries in this capital market, and some of these are merchant bankers, portfolio managers, underwriters, portfolio management services, stock brokers and all. And in India, the capital market is regulated by SEBI, Security and Exchange Board of India. It's a very important, what you can say, thing that you understand about SEBI, not just for this semester but also for the upcoming semesters too. Okay, so make sure you thoroughly understand whatever is given in this unit. SEBI was established in 1988 as a non-statutory body, but later on, if you remember Harshad Mehta Act of Scam 1992, SEBI was forced to government was forced to pass the SEBI Act of 1992, and it accorded our SEBI with statutory power. The major objective of SEBI is to protect the interest of the investors as well as development and regulation of the stock exchange so as to prevent any deceitful malpractices and regulate and develop a code of conduct for intermediaries such as brokers, underwriters and all. SEBI performs various functions like registration of stock exchange, mutual fund, underwriters, brokers and sub-brokers, and also levies various fees and other charges to promote investor educations, audit and inspection of stock exchanges and various other intermediaries. SEBI also prohibits unfair trade practices relating to the securities market as well as insider trading. Again, capital market, all these things that we discussed so far, these are also favorite topics for term and examination question paper makers. Okay, so please go prepared when you go for your term and examination. So I hope you guys got an overview of what are the things that are covered in Unit 5. Now when you go and read your MMPC 3 course, Unit 5, which I strongly recommend, I hope you guys will find it much better to understand the concepts that are mentioned over there. Thank you so much for sticking till the end. I hope to see you all in the next session. Until then, take care. Bye-bye.